The S&P 500 has hit dozens of all-time highs this year. Your portfolio is up, everyone on social media is celebrating. But here's the question nobody wants to ask out loud. Is this real growth? Or is this 1999 all over again, right before everything came crashing down? Because right now, just 10 companies control over 40% of the entire S&P 500. That is a bigger concentration than the market had at the exact peak of the dot-com bubble. And almost all of it is riding on one word: AI. By the end of this video, you'll know exactly
how to tell the difference between a genuine boom and a bubble about to pop, and where the smart money is actually positioning right now. Let's break it down. 2026 has been a wild year for the stock market. The S&P 500 has notched over 20 new all-time highs. On paper, that sounds like unstoppable growth. But underneath that headline number, something strange is happening. Most of the market isn't actually going up. The gains are being carried almost entirely by a small handful of AI-linked mega-cap stocks. Strip those out, and the picture for the average stock in the index looks a lot weaker.
that disconnect, a few giants soaring while everything else lags, is exactly the kind of pattern analysts get nervous about, because it's strikingly similar to what happened right before the dot-com crash in 2000. So which is it? Is AI a once-in-a-generation technological shift that justifies these prices? Or are we watching investors pile into hype the same way they did with Pets.com 25 years ago? Let's start with the strongest argument for this is real. Unlike the dot-com companies of 1999, many of which had no revenue, no profits, and no real business model, today's AI leaders are making enormous amounts of actual money.
We're talking about companies with massive free cash flow, strong profit margins, and earnings growth running 2 to 3 times faster than the rest of the market. This isn't hype funding empty promises. A huge share of AI infrastructure spending is coming directly out of company profits, not runaway debt. The valuation gap tells a similar story. Some of the most expensive dot-com stocks were trading at valuations that made no mathematical sense, multiples so extreme they'd take decades of growth to justify. Today's AI leaders, while expensive, are trading at levels that, while historically high, are nowhere near those dot-com extremes.
And the demand? It's not speculative. It's backed by actual multi-year purchase commitments from the largest technology companies in the world, spending hundreds of billions of dollars because they believe AI infrastructure is the next essential utility, like electricity or the internet itself. That's the bull case. Real earnings, real cash flow, real committed demand. Now, let's steelman the other side, because the warning signs are just as real. First, concentration. When the top 10 companies control over 40% of the entire index, the market isn't really diversified anymore. It's a bet on AI succeeding, dressed up as a broad market index. If those companies stumble, they don't just fall, they drag the whole index down with them.
Second, the adoption gap. Companies are spending hundreds of billions of dollars building AI infrastructure, but actual enterprise adoption, real businesses using AI in ways that generate meaningful revenue, is still sitting under 20%. That's a massive gap between what's being spent and what's actually being monetized right now. Markets are pricing in a future that hasn't arrived yet. Third, the valuation multiple itself. The Shiller P ratio, a long-term valuation measure, has crossed 40, a level the market has only touched one other time in its entire history, right before the dot-com crash. History doesn't repeat exactly, but that number alone should make any investor pay attention. And fourth, the funding shift. Early in this AI build-out, spending was funded mostly by cash flow. That's now starting to change, with some of the biggest players turning to debt to keep the build-out going. That's a meaningful shift, because debt-funded expansion is far less forgiving if growth slows down. Here's the honest answer. It's not fully one or the other.
What most analysts agree on is this: AI itself is not fake, and the earnings behind the biggest players are real. But the price you're paying for that earnings growth has become stretched, and the market's reliance on a tiny group of stocks makes the whole index more fragile than it looks on the surface.
Think of it less like bubble versus no bubble and more like a spectrum. Certain corners of the AI trade, the most speculative, most hyped names, look closer to bubble territory. The profitable, cash-generating leaders look closer to justified growth. The danger is that most investors, through index funds, own both categories mixed together without realizing it. So what do you actually do with this information? Move one, know what you own. If you're invested in an S&P 500 index fund, you're far more concentrated in AI and mega-cap tech than the name diversified index suggests. Check your actual sector exposure instead of assuming.
Move two, don't chase, and don't panic. Trying to time the exact top of a trend like this is nearly impossible, even for professionals. Instead of guessing when it pops, focus on whether your overall allocation matches your personal risk tolerance and timeline. Move three, watch the signals, not the headlines. The things that actually matter are earnings quality, whether AI capital spending keeps being funded by cash or shifts further into debt, and interest rate policy.
Those are the real signals, not whether a stock had a big green day on social media.
Move four, consider rebalancing, not exiting.
If AI-linked stocks have grown to dominate your portfolio simply because they've gone up so much, trimming back toward your original target allocation isn't bearish. It's just discipline.
Here's the truth. Nobody rings a bell at the top of a market. The people who got hurt in 2000 weren't wrong that the internet mattered. They were wrong about the price they paid and how concentrated their bets became. AI might really be the biggest technological shift of our generation. That doesn't mean every price today is fair, and it doesn't mean your portfolio is automatically safe just because the index keeps hitting new highs. I'm tracking the valuation data, the earnings reports, and the Fed's next moves every single week, because the moment this story shifts, you're going to want to know before your portfolio finds out the hard way. Subscribe, and I'll see you in the next one.